Welcome to Titan's War, where we uncover the strategies and mindsets of the world's greatest financial giants. If you're ready to think differently about money, hit that subscribe button and let's dive in. Warren Buffett's genius isn't just picking stocks, it's the way he thinks about money, business, and people. Robert Hagstrom, author of Inside the Ultimate Money Mind, explains that Buffett's true edge is his mindset. He doesn't chase fads, he doesn't get caught in market hysteria, he calmly evaluates businesses and allocates capital where it will grow best. Buffett himself once said, "There are a lot of smart people who make terrible investment decisions. So intelligence alone isn't enough. What matters is discipline, patience, and a framework that keeps you grounded. That's the money mind." Warren's obsession with business started young. At just 11 years old, he bought his first stock. But the real turning point came when he found a book called 1,000 Ways to Make $1,000. One story was about a man who bought 3 weighing machines and reinvested his profits until he owned 70. This simple story lit a fire in Buffett's mind. It taught him the ultimate wealth-building secret: compounding. Use the profits from one venture to fuel the next. That single idea became the foundation of Buffett's empire. Buffett became a learning machine. He devoured biographies, annual reports, and investment case studies. This endless reading gave him 2 superpowers. He could spot extraordinary businesses faster than anyone else. He could also sniff out red flags before others noticed. Buffett's message is clear. If you want to build a money mind, you need to study relentlessly, not just prices, but people and businesses. But knowledge isn't enough. Action matters. Buffett is famous for acting decisively when the odds are in his favor. He doesn't get lost in predicting recessions or worrying about interest rates. He focuses on a single question: is this business worth more than what the market is asking? If the answer is yes, he moves. No hesitation. In his 20s, Buffett launched his first investment partnership. While the Dow returned 74% between 1957 and 1964, Buffett's partners made over 250%. Why? Because Buffett protected them. He structured his deal so he only made money if they earned above 6%. This wasn't just smart finance, it was character. Buffett built trust, and with trust came more capital, the fuel for his legendary career. Buffett started as a strict Benjamin Graham student, buying cheap, overlooked stocks. But over time, he realized something crucial. It's better to own a great business at a fair price than a bad business at a cheap price. The turning point was See's Candies. In 1972, Berkshire bought the company for $25 million. Some thought it was expensive, but over the decades, See's generated nearly $2 billion in profit. The lesson? Strong brands, loyal customers, and durable business models beat cheap stocks every time. Charlie Munger changed Buffett's worldview. He pushed him to seek businesses with quality and durability, not just low prices. Then came Phil Fisher's wisdom: only buy businesses you truly understand. Stay within your circle of competence. Together, these ideas reshaped Buffett's strategy, focusing on resilience, trust in management, and long-term growth. Benjamin Graham once said, "To invest successfully doesn't require a stratospheric IQ. What you need is a sound framework and the ability to stop emotions from corroding it." That's why Buffett says, "Be fearful when others are greedy, and greedy when others are fearful." Your biggest enemy in investing isn't the market, it's your own fear and greed. Master those, and you master the game. Today, Buffett's philosophy has evolved again. He's invested in giants like Apple. Because in the modern era, value often comes from network effects. The more users a platform like Amazon or Google has, the more powerful it becomes. Every search, every purchase, every user strengthens the business. Buffett's money mind is not static. It adapts. And that's the key lesson. Your framework must evolve with the world. So what can we learn from Buffett? Study businesses like your life depends on it. Focus on compounding, not quick wins. Act when the odds are in your favor. Control your emotions. Adapt as the world changes. Buffett's success wasn't built on luck. It was built on patience, discipline, and a money mind. Something you can start developing today. If you enjoyed this deep dive into Warren Buffett's mindset, hit that like button and subscribe for more strategies from history's greatest investors. This is Titan's War. Thanks for watching, and remember, the real edge in investing isn't intelligence, it's discipline. My process is influenced heavily by Buffett. Like him, I don't chase quick wins, risky trades, or the next meme stock. I'm not here to gamble with my future, and I know many of you watching feel the same way. Instead, I focus on a long-term buy and hold strategy. Something steady, proven, and conservative, something that builds wealth like a snowball rolling down a hill, slow at first but unstoppable over time. Too many people today are hunting for the next big thing. In 2021 it was tech stocks. In 2022 it was commodities. Everyone wanted to get rich overnight. But here's the truth. While you might get lucky once or twice, no one consistently builds wealth by gambling on hype. Buffett's approach is different. He invests in businesses that produce strong cash flows year after year, businesses that keep compounding even when the market panics. That's the mindset I've adopted. I'd rather own something proven and time-tested than chase a rocket that eventually crashes back to Earth. Part of my portfolio sits in simple index funds like Vanguard's S&P 500 ETF, ticker VOO. But I also hold individual stocks inspired by studying the greats, Buffett, Munger, Guy Spier, Monish Pabrai. These investors have left us a roadmap, and I've built my own investment checklist based on their principles. My 6 investment principles, inspired by Buffett. 1. The business must be simple and understandable. If I don't understand what a company does, I won't invest in it. Complexity creates risk. Buffett made billions from Coca-Cola and Apple. 2 simple, easy-to-understand businesses. Back in 2015, when iPhone sales slowed, most people ran from Apple. Buffett stepped in. Why? Because he understood the business, believed in its future, and bought when others doubted. Sometimes the best investments are boring, but boring makes money. 1. Consistent revenue and earnings growth. I don't want a one-hit wonder. I want companies that grow steadily. 10%, 15%, maybe 20% per year. Fast growth like Peloton had is dangerous. It attracts competition and often collapses. But steady growth compounds quietly, and over decades, it creates fortune. 1. A strong moat. Competitive advantage. This is one of Buffett's favorites. A moat protects a business from competitors, like Coca-Cola's global brand, or Amazon's unmatched logistics network. A company with a wide moat can dominate for 25, even 50 years. That's the kind of business I want to own. 1. Honest and competent management. I look for leaders who act in the best interest of shareholders. I study their reports, watch their interviews, and track whether they buy back shares or constantly dilute shareholders. Great managers build value, poor managers destroy it. It's that simple. 1. High returns on capital. As Charlie Munger said, over the long term it's hard for a stock to earn a much better return than the business earns. If a company earns 6% on capital, your stock will likely give you around 6% too, but if it earns 18% year after year, even at a higher price, it's a fantastic investment. That's why I look for companies with strong returns on invested capital and equity. 1. Buy at an attractive price, margin of safety. Buffett says, price is what you pay, value is what you get. If a stock is worth $100 and I can buy it at $50, I've given myself a cushion. Even if I'm wrong, I still come out ahead. That's the power of a margin of safety. The philosophy of value investing. 1. Stocks are ownership in real businesses. When Buffett buys a stock, he treats it like he's buying a farm or a coffee shop. He doesn't care about daily price swings. He cares about the business. Think about it. Would you buy a money machine that loses $1 billion a year? Of course not. Yet people do it with hype stocks all the time. 1. Margin of safety. Always buy more value than you pay for. That single principle separates successful investors from speculators. 2. Mr. Market is your servant, not your master. Buffett borrowed this idea from Benjamin Graham. Imagine Mr. Market shows up at your door every day, offering to buy or sell at random prices. Some days he's euphoric and overpriced. Other days he's depressed and selling cheap. The key, you don't have to swing at every pitch, you wait, patiently. And when the perfect pitch comes, you hit it out of the park. That's what Buffett did with Apple. 1. Don't lose money. Buffett's #1 rule, don't lose money. Rule #2, don't forget rule #1. Why? Because a 50% loss requires a 100% gain just to break even. Protecting your capital is the foundation of compounding. That's why Buffett is so careful. Final words. My entire approach is built around these principles. No shortcuts, no hype, just steady, proven strategies that compound over time. So if you're serious about building wealth, don't chase the lottery ticket. Learn from Buffett, build your own checklist, and think long-term. Because the truth is, wealth isn't built in a day, but with patience, discipline, and the right mindset, it is built. Now, let me know in the comments. Which of these principles resonates with you the most, and what would you add to your own investment checklist?